retracements and reversals. Now, the ability to spot or point out a difference between a retracement and a potential reversal is a great tool to add to your arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement or a potential reversal. Now, what we have to remember is that an asset, when they're trending, should trade in what we call peaks and valleys, or highs and lows. A market should push up and then ease down, and then push back up and ease down, and push back up and ease down. These are the peaks and valleys created by the surge between buyers and sellers. And a trend, okay, is not a straight movement. Price doesn't move in straight lines. Price moves in these pushes and eases, okay? Because what happens is buyers start entering the market here for whatever reason, and it gets to the point where price is pushed up to a level where the buyers who were already in the market said, okay, I've made the profit potential I was looking for. I'm going to sell at this level, and they sell and they're gone from the market, or temporarily from the market. Others, buyers that were looking at the market, waiting to find an entry point, say, at this point, the asset's too high. I'm going to sit back on the sidelines for a while, and when it gets to a lower level, I'll enter the market. So what happens is the market eases down. At some point, those buyers that were sitting on the sidelines start saying, that's a reasonable price. I'm going to enter that market. Or the buyers who had sold at this level say, I'm going to re-enter that market. And that pushes the next level up, so on and so forth. And this happens continually. And the more defined these peaks and valleys are, the more defined your trend line is. Okay? But they don't move necessarily this way, this way, this way, this way, this way. Okay? They can move sideways. They can be all over the place. But the more developed a trend and the higher quality of the trend, the better your trading can be. So today's focus in this webinar is to provide you some information and knowledge needed to accurately determine whether an asset's trend is forming a retracement or preparing for a reversal. Now, one of the most important reasons to be able to determine this is we would like to enter a market down here and exit a market up here. We don't want to, because what happens is too many buyers panic when the asset starts to decline, and they exit the market. Yes, they might exit the market with a profit, but they could have exited that market with a lot more profit. And the idea is to make as much profit as you can in good trades and minimize your loss on bad trades. But if you're every time a market starts to ease down, you think it's going to fall and collapse on you, you sell, you're cutting your profit. And then, yes, you can always re-enter that market when the asset is recovered, but then you're losing all of those pips, all of those points from the spread. So you're giving away your profit. But at the same time, you need to be prepared if that retracement becomes a reversal so that you're out of the market without a loss. And this is why properly placing your stop losses is quite important. Now, let's start out with some basic definitions. Retracements are momentary reversals that often occur during longer trends. Unlike reversals, retracements show a continuation of an opposing trend within a targeted asset's price action. So as you can see in the picture on here to the right, there are a couple of retracements that take place that occur throughout a prolonged period of time. Push, ease, push, ease, push, ease. Now, if you can constantly train yourself to understand that an uptrend or a downtrend must be made up of these pushes and eases, you'll tend to expect this and you won't panic. And you'll know that this is a good sign. Too many traders think it's a bad sign and exit, like I said, exit the markets too soon. A reversal, on the other hand, is telling you that market trend is ending, and if you were in a buy position, you need to get out of the markets. Reversals are temporary changes in an asset's trend that occur over a short period of time. Often these reversals can last minutes, hours, or days. It just depends on what time frame you're utilizing for your charts. Reversals are oftentimes drastic and do not represent a long continuation of an opposing trend during the price action, like seen with retracements. In the picture below, we'll go over to in a second, we'll see several examples of what they look like. So we saw the retracement, push and ease, push and ease. When we finally pushed up here and it eased back down, it didn't retrace back up. Okay. And if you look at how low the price had fallen, and there's ways that you can judge these levels, okay? Because what we're looking at in a trend upward, we're looking to form higher highs and higher lows. That means this low that was reached here, okay, that's the lowest low. When it retraces, it should never fall below that lower low. When this asset then came down here and we were expecting it, hoping it would bounce back up, and it didn't, and it moved back below that previous low and back lower, you now know or are expecting that you're into a problem situation. Now, this wasn't a retracement here because this trend had ended. It became a full reversal. Okay. So when it's not a retracement, at this point, you know that asset's not retracing. You want to get out of that marketplace, or if you're looking for a buy point, an entry point through this trend, you won't see one anymore. Now we're looking at the market shifting to a downtrend. So this is why seeing the difference and knowing the difference and being able to spot the difference between a reversal and a retracement are very, very important. Now, successful investing is predicated on knowing the answer to that question. Okay. Now, there are some basic ways that we can spot the difference between a retracement and a reversal. But it's more about the change in technical indicators in charts in volume and support and resistance lines than it is about fundamental factors. So we can answer the question that's all important to the market. Is it a retracement or is it a reversal? So the first thing we could look at on a chart is volume. So when we see profit taking by retail traders, small blocks of trades, it's usually a retracement. If we see a major selling or a major in opposite selling, it's institutional selling, huge, large blocks of trade. That's telling you it's a reversal, most likely. Money flow is very hard to see. Chart patterns are very interesting. Now, there are few, if any, reversal patterns except for really candlesticks. Very few will tell you that a reversal is happening. They can tell you a market is overbought or oversold. Where there, for retracements, there's nothing you're really going to see in a chart pattern or that's going to tell you that it's a retracement, except if you're using trend lines of support and resistance. Now, reversals you'll see with chart patterns like double tops, double bottoms, triple tops. You'll see it with head and shoulders patterns. Okay. Now, short interest, that's something you're not going to see on charts. Time frames. A retracement is usually a short-term reversal, lasting no longer than a short, depending on what you're trading, but a short period of time, where a reversal can take place over a much longer period of time. You have a retracement, usually has no change in the fundamentals. Because if the market starts easing down, but you have ECB notes, or you have a bad economics report or a good economics report, okay, those are changes in fundamentals. Usually, major fundamental change, like a big miss in a report, change in a bank action, a change in inflation forecast, could spark a full reversal, and you'll see that mostly in reversals. Okay, candlesticks are a very good way to see these, because what you'll see is specific patterns in candlesticks, especially things like spinning tops, dojis. Candles show indecisiveness for a point. The candles, the bodies of the candles, when it starts into a retracement, are very small. Reversals, okay, we have very defined chart patterns for candles. We have engulfing, we have three black shoulders, three white crows, and there's other similar patterns, inside outs, that will show you a market reversal or indicate there's a market reversal taking place. The best way to see it is the price action on charts. See whether the asset is making higher highs and higher lows, or lower lows and lower highs, as well as support and resistance zones, and things like Fibonacci levels. Is it breaking a Fibonacci level and falling to the next one and not bouncing off of it? Did it break to 50% and come down to 62.8? So whenever a price reverses, most traders and investors are faced with tough decisions. They have three options. The first, they can hold off. They can hold throughout the sell-off, which could result in larger losses. The retracement turns out to be a larger trend reversal, but it won't be if you place your proper stop losses. They could sell and rebuy if the price recovers, which would definitely result in money wasted on commissions and spreads. This may also result in missed opportunities as the price recovers sharply. Three, they can just sell permanently, which could be a missed opportunity if price recovers. Okay. I firmly believe in one, holding off, okay? And I want to, at all times, watch my prices, my support and resistance, my trend lines very, very carefully. The minute I see a lower low, even if for a spike for a second, then I'm saying, you know what, let me get out of the market. And then I'll sell permanently, okay? Because you know what, as long as I've reached pretty close to my profit target, okay, then I'm happy. You don't have to be greedy. But by properly identifying the movements as either a retracement or reversal, you can reduce costs, limit loss, and preserve gains. Now, traders have an expression for attempting to pick a market top or bottom. They call it trying to catch a falling knife. And that's exactly what it is. You'll never catch it right on the nose. You'll never guess it or see it right when it happens. But if you're protecting yourself by proper stop losses, by exercising a lot of caution, and by using tools that will help you see whether the minute is no longer retracement and looks like it's moving to reversal, that you can react. Because remember, retracements are healthy. A market in general can become tired of moving in the same direction. It takes a lot of work and money to send assets to higher highs. When the price gets too high, buying pressure runs out when the money dries up. When demand dries up, price begins to fall and causes the chart to head south. This causes the security to become more appealing to prospective buyers who believe that the stock or the asset has the potential to move higher. So you can see that after a retracement, the asset was unable to push to higher highs. Instead, a security rolled over and created higher lows. Well, that's telling you have a problem. So the security pushed up, wasn't able to make the higher high, came down, formed a lower low, but came back up, and it wasn't able to form a higher high. It wasn't able, even though we had a retracement, what it's telling us is that momentum that it recovered wasn't enough. It wasn't able to get back above where it was. It came back up, but it didn't form a higher high. So now you know you have a reversal in the making. So let's set some guidelines. Reversals are defined as change in the overall trend of a price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal occurs. So what should you do? Again, when you're faced with a possible retracement or a reversal, you only have three options. That's it. There's only three choices you can make. And you should make those choices ahead of time. If in a position, you could hold on to your position, this would lead to losses in the retracement and turn out to be a larger term reversal. You could close your position and re-enter it if the price starts moving with the overall trend again. And lastly, you could close permanently. This could result in a small loss if the price went against you far enough, or a huge profit, depending on the structure of your trade and what happens after. But you need to always be prepared. Because reversals can happen at any time, choosing the best option isn't always easy. Now, there are some technical tools that we can use. And the following, the most popular are Fibonacci retracements. Now, tonight, we're not going to get into Fibonacci retracements because we have a whole 1 hour class on it. It takes more than an hour, really, to teach you about fibs. You also have support and resistance levels, and these are crucially important. You should always have these on your chart. And then lastly, trend lines and chart patterns. So let's go over and look at some live charts for a second. Oh, why didn't my charts pop up? Hold a second. Okay, so here's a current live chart of the Euro US dollar. Now, I've dropped on there pivot points, support and resistance from eyeballing, and you can also see the Fibonacci levels, okay, that were already put on the chart. So you see the fib levels here. You can see right here, I've drawn on support and resistance the last time the price was up near this level. And I used a pivot point chart for the calculation. And I also went back to historic prices to look and see what price was crucial. Now, we see price moving, push, ease, push, ease. Now, what happened was, look at that. That high came all the way up to my crucial resistance zone and bounced off of falling down. It came back down and it came right through the Fibonacci level. And look at it, look how it played right on the Fibonacci and then reversed and bounced up. Now at this point, we're not sure if it's going to recover to make a higher high because it has to break above this point to continue that uptrend. Now it's moving up steadily. It's come through the price point is right here and it's moving up towards that higher fib level. We're looking for it now to make a higher high. Now look at the lows. Okay. So those lows didn't fall below the last lows of the E's here and there. So we look at this point that we have a recovery of that price. Okay, and we're going to return to the uptrend. We could add onto our charts a little bit of volume. And we can also see in our volume indicators down here, okay, we had a lot of selling in here, and then we moved back into buying, but buying is very, very weak at this point, extremely weak. So I don't know if there's any conviction in this price movement. So I would be getting a little bit worried because I'm not seeing an increase in buy level to this point. But if I look back to where the buying was as the asset was moving up, I also didn't see a lot of strong buying movement. Now, the fact is, we don't know whether the euro is going to have the psychological ability to break the 124.20 level. Okay. So we might think that it's not going to be able to break back above this, but we need to wait. But if I was in the market already and I had entered the market somewhere down here, I would feel comfortable to stay in the markets, but I'd be watching pretty closely. Okay. If I was looking at a point to enter the markets, okay, and I had sold somewhere here, would I re-enter with a buy now? possibly, because you would have still made the points in that price movement. But if you're looking at the longer term trend, and this is just a 1 hour chart. Now, we can also see in other charts, we can see really in-depth analysis here using a Wyckoff distribution of price in this downtrend, moving in beautiful pushes and eases down. Okay, this is a downtrend here. Look at that. Ease down, bounce back up, ease down, bounce back up, ease down, bounce. Now, each time it eased back up, it eased back to that trend line. But then at some given point, at this point here, it broke above that trend line and started making higher highs. And this became what would have been, or what was, a reversal. But then it didn't. It moved back into another downtrend here, which wasn't part of that downtrend. So we had thrusts and climaxes. We had shots of weakness. We had thrusts here. Okay. All of that can be analyzed when you're looking for the pushes and eases in the market, and you're looking to, but there's a difference between looking and analyzing and what you would be doing if you were in the markets. Okay. Now, this is a beautiful strategic one. We don't even really have a uptrend here. We have more of a downtrend here. So we see the fall. Let me get my marker back on here. So we see the asset push down. It forms a lower low, bounces back up, makes a lower high, falls back down, giving us a lower low, moves back up, gives us a lower high, falls back down. But now what happened was this crucial support level held at this point. Okay, so that's telling us that that downtrend could be over. So at this point, if I had entered the market somewhere here, I would be exiting the market, because at this point we see volume falling, but we also we're unable to continue up to make newer highs. Now we reached that downtrend line, so it's fairly nice, but the resistance line held here. So it's a little bit indecisive. We want to see what's going to happen right here. I would guess it's going to break out this way. But the difference is when determining where you're going to enter or exit the market. You know, if you have money riding in the market, it's one story because you want to get out with the most profit. If you don't have money in ride, you're looking for entry points. So let me get my markings off of here. So let's go back to my PowerPoint and spend a few more minutes talking about. So actually, I'm going to pop you up a video that will explain a little bit better than I do